Welcome to this explainer. Okay, today we're diving into a showdown that is literally as old as the markets themselves, the massive clash between chasing adrenaline and building real lasting wealth. We're going to look closely at why human biology is actually working against your portfolio and what happens when our natural craving for action goes head to head with cold, hard compounding math. Right off the bat, let's just look at the stark contrast between these two paths. Trading feels like a thrilling roller coaster, right? It's fast, it's visceral, and it really gets your heart racing. Every single tick of the market feels like this high-stakes opportunity. Investing, on the other hand, well, it feels like a painfully slow escalator. It just plods along day after day with barely any noticeable movement in the short term. And because of this, naturally, most of us choose the excitement. Our brains are hardwired for that immediate feedback and stimulation. I mean, who wouldn't pick a thrilling roller coaster over a slow set of moving stairs? But here's the thing. When you look at the actual data behind that choice, it is brutal. Over the exact same time periods, the incredibly boring path of the investor quietly and relentlessly destroys the active path of the trader. And that staggering 80% failure rate right there, yeah, that is the jump scare we're unpacking today. Consider it a massive wake-up call to the trading fantasy that dominates so much of the financial media we see every day. All right, moving into section 1, the illusion of control. Let's look at why we love trading. We really need to understand why our brains naturally crave this high adrenaline choice, even when the data is screaming at us not to. It starts with the undeniable allure of fast money. Next thing you know, you're studying charts, watching those green and red candles just explode across your screen. You start making predictions. And honestly, today's gamified trading apps are literally designed to exploit this. They deliver massive dopamine hits every single time your phone pings or showers you with digital confetti. It's a deeply addictive loop built entirely around chasing quick riches. The energy escalates, the charts seem to move faster, and your brain is just flooded with anticipation. And it all really boils down to this crucial psychological hook. It feels powerful. When you're locked into those fast charts, reading the patterns and firing off trades, your brain is being tricked. It's tricking you into feeling this sense of absolute, unyielding control over your money. You feel like you're the master of the market, right? Like you're outsmarting the whole system. But this constant, high-stakes engagement leads straight to severe decision fatigue, wearing down your willpower and ultimately causing completely irrational choices when the market inevitably turns against you. Which brings us to section 2, the brutal reality. Let's look at the actual numbers. Okay, it's time to shift away from that energetic chaos for a second and do a calm, data-driven reality check. Because the actual numbers tell a devastating story that is completely detached from that fantasy of control. Roughly 80% of day traders lose money within just 2 years of starting. Let that sink in for a moment. The overwhelming majority of people who chase that roller coaster, who pour all their time, energy, and capital into actively beating the market, they end up crashing and burning in just 24 months. But honestly, the really painful twist is hiding in that remaining 20%. You'd naturally think these survivors are out there making millions, essentially justifying all of that insane effort. But the data shows that even the few who are actually profitable barely outperform the broader stock market. When you start factoring in the massive friction of short-term capital gains taxes, those persistent bid-ask spreads, and the accumulating transaction fees, even the winners in the day trading game are mostly just spinning their wheels. They're burning immense mental energy and taking on massive risk just to match the completely boring passive baseline. Let's look at section 3, the $10,000 experiment. Trader versus investor. To see exactly how this plays out in real life, let's run a tangible experiment. Abstract stats can be kind of hard to wrap your head around, so let's make this practical. Picture two hypothetical people. They're starting at the exact same point in time, and they both have exactly $10,000 to their name. But they're about to make one profoundly different choice. One chooses the highly active path of the trader, and the other chooses the deeply passive path of the investor. Let's follow the trader first. Right out of the gate, this person feels completely unstoppable. They hit the ground running, executing multiple complex trades every single day. I mean, they're checking their phone at dinner, analyzing pre-market futures before they even get out of bed in the morning. They get a few big wins, experience some fast gains, and their confidence just explodes. They genuinely believe they've cracked the code of the financial system, essentially confusing a lucky bull market run with actual repeatable genius. Meanwhile, let's look at what the investor is doing. Their journey looks incredibly, purely boring. There is absolutely no excitement here, zero adrenaline. It's just pure, calm patience. In fact, the investor is practically taking a nap while our trader is sweating over charts. They bought a broad, low-cost index fund, set up their automatic monthly contributions, and simply walked away. They're spending their time just living their life, quietly letting the broader market do all the heavy lifting for them. Now, watch how this timeline unfolds over a decade. In year 1, we have that huge contrast, trader euphoria versus investor calm. But by year 5, the macroeconomic environment shifts. Volatility strikes, and reality starts fighting back against the trader. We start seeing emotionally driven decisions to recoup sudden losses, panic selling, revenge trading, the mounting stress of those devastating red candles. But the investor? They're totally steady. They experience the exact same market drops, but there's no panic selling. Just a zen-like calm, steadily acquiring more shares at lower prices through those automated contributions. And by year 10, the trader is financially devastated and completely burnt out, while the investor has grown incredibly wealthy through quiet, uninterrupted compounding. And that leads us to Section 4, the wealth of patience. Let's talk about the final payoff. After a decade, the wealth gap between these two identical starting points is absolutely staggering. And it all boils down to this fundamental difference. One person chased excitement, and the other person chased math. Compounding math is the real secret here. By avoiding the friction of frequent taxes, dodging those transaction fees, and, most importantly, preventing emotional, unforced errors, the boring investor allowed their money to multiply upon itself year after year, completely uninterrupted. And guys, this is exactly why this matters so deeply to you. The hard truth is that financial markets reward patience far more generously than they reward excitement. But as humans, we naturally crave that thrill, giving into that psychological weakness. Choosing the visceral high of the roller coaster over the slow, reliable escalator, it ends up costing everyday people literally millions of dollars in unrealized potential over their lifetimes. We are biologically hardwired for thrill-seeking, but the stock market actively and ruthlessly punishes that exact behavior. So I'm going to leave you with a direct challenge to your financial ego today. Be absolutely brutally honest with yourself. Are you a trader or are you an investor? And when you look closely, right past the adrenaline, past the bragging rights and the excitement, what are your real returns? Factor in your time, the massive stress, and those taxes. Let me know your honest answer down in the comments. Thank you so much for joining me for this explainer, and I'll see you in the next one.